It's a common adage that your taxes or tax liability will go down in retirement. Because of this, I see a lot of people deferring taxes into the future. After all, why pay taxes while working when taxes are supposedly higher when you can instead contribute to something like a pre-tax account, receive a tax deduction today, and then later withdraw that money in retirement and pay taxes at a supposed lower rate? In some ways, this adage is true. In other ways, it's quite incorrect. In today's video, I want to talk about when it's true and when it's incorrect and why it's important to know the difference. Let's first start by comparing two people, an individual working in Texas versus a retiree in the same state. Both individuals have a pre-tax income of $100,000. Now, the worker's income comes all from earned W-2 income. Now, we are just comparing income tax liabilities here, and so we're going to be leaving off things like payroll taxes, sales tax, property tax, and more. As we can see on the screen, a worker in 2025 would owe a bit more than $13,600 in taxes, leading to an effective tax rate of over 13.6%. The retiree's income is made up of a few sources: a $30,000 Social Security benefit, $24,000 in dividends and long-term capital gains, and another $46,000 in traditional IRA withdrawals. When comparing taxes, we see a stark difference in effective tax rates. The retiree has nearly $3,000 less in taxes that they will owe. So it appears that this adage has some real truth to it. Taxes are indeed lower in retirement when equalizing out income. And you know what? This will always be the case, at least when we compare effective tax rate. At worst, taxes will be equal, but most commonly will be lower for a retiree. And here's why. While working, your income is taxed at one rate, ordinary income rates. Earned income is always taxed at these ordinary income rates, which tends to be the highest rate on any kind of earnings. But in retirement, you have a lot more options. Withdrawals from a Roth account are tax-free. At most, 85% of your Social Security benefit is taxed. Capital gains and dividends are taxed at lower, more preferred rates. It's only traditional IRA and pension income that will be taxed at the same rates as earned income. So if you have any amount of Social Security, Roth withdrawals, or dividends that make up your income, you will always have a lower effective tax rate than someone with equal income that's working. But the thing is, this doesn't really matter all that much. Just because your effective tax rate will be lower in retirement doesn't mean that you should try to defer taxes as much as possible to retirement. Well, this is an area where context is really important. The idea that taxes will be lower in retirement is a partial truth. When you save for retirement in a retirement account, you have an important choice to make. You can either pay tax now and never be taxed again in the form of Roth contributions, or you can decide to avoid taxes now and defer them into the future in the form of a pre-tax contribution. Do you want to avoid taxes now or avoid taxes later? In deciding which is best, tax rates matter. I have a simple cheat sheet at the bottom of the screen. If the tax rate today is lower than the tax rate in the future, pay taxes when saving today and go Roth. The point is very obvious if I give you a hypothetical example like Congress raising taxes. Say Congress raises each tax bracket 10%. So the 10% bracket becomes 20%, the 12% bracket becomes 22%, and so on. If I told you this was happening in 2030, there would be a mad dash to contribute to Roth accounts and do Roth conversions. Why? Because tax rates would be far lower today. On the opposite side of the coin, if you're making a contribution today and taxes are really high due to your working income, and you believe tax rates will be far lower in retirement, then you would want to contribute to pre-tax accounts. An example of this would be a high-earning employee earning $1 million a year. This person is in the top tax bracket, 37%. If this person was contributing $10,000 to a retirement account, it's unlikely that they would pay a tax rate higher than 37% when withdrawing that money plus growth in that account. So this person should contribute to pre-tax accounts. The thing we need to understand here is effective tax rate doesn't matter in this situation. You don't contribute or pull money from retirement accounts based on effective tax rates. You do so based on marginal tax rates. So let's go back to the initial worker versus retiree comparison. For hypothetical purposes, let's say this is a side-by-side comparison. This person was working, making $100,000 pre-tax, and in retirement, this is going to be a snapshot of their situation, and they will also be taking $100,000 pre-tax. I realize this isn't a realistic scenario that they would need $100,000 pre-tax in both scenarios. What matters is the net amount, but bear with me for this hypothetical example. The worker is currently deciding if they should contribute to a Roth account or pre-tax account with their savings. Now, most people would think that the worker should contribute to pre-tax accounts and defer taxes into retirement. We clearly see the effective tax rate is lower in retirement after all. Giving you more information, the worker is currently in the 22% bracket. If they can contribute to Roth, they will pay 22% on that contribution. If they contribute to a traditional IRA, they avoid 22%. This seems like a pretty easy decision on the surface. All data points to deferring taxes. Well, let's look at the retirement situation in a slightly different way. Yes, we know the effective tax rate in whole for this retiree is almost 11%. But let me break up part of their income, and for a second, let's just eliminate the IRA withdrawals. This person has $54,000 of income then, $30,000 coming from Social Security, $24,000 coming from capital gains and dividends. If we rerun this person's tax situation, we see a pretty surprising outcome. At $54,000 of income, this person owes nothing in terms of taxes. This means that all $11,000 of income tax that this retiree owes is triggered by the IRA withdrawals. If we take a look at this a little bit differently and break out the math, $10,944 in taxes being triggered by the IRA withdrawals means that this retiree is paying 23.8% as a tax rate on those withdrawals. Now, some of you may be thinking I'm just messing with the math and framing this in a way to make it look like tax rates are higher for this retiree. For instance, why am I separating the IRA withdrawals from the other income? I'm doing this because this is how tax planning actually works. Without the IRA withdrawals, the dividends and capital gains are in a 0% tax bracket. Any amount of Social Security that is taxable is still currently underneath the standard deduction. This person has no tax liability without those IRA withdrawals. Going back to the worker versus retiree comparison, remember that worker has a 22% marginal tax rate. If they continually contributed to pre-tax accounts, then they would have to pull from pre-tax accounts to fill in their remaining income. And they end up avoiding a 22% tax rate on contributions to instead pull those dollars out at 23.8% in retirement. If they decide to contribute to a Roth instead, they pay a 22% tax rate on contribution to avoid this 23.8% tax rate in retirement. Again, this is how real tax planning works. The IRA withdrawals trigger all of the tax liability, so we can really assign the tax to those IRA withdrawals. Let's dive deeper into looking at marginal rates visually. Well, working the brackets are pretty straightforward. In this simplified example of just looking at earned income, the marginal rates are the actual tax brackets. So at $100,000 worth of income for this worker, they're in the 22% marginal tax bracket on their last dollars earned. In retirement, their tax graph looks a whole heck of a lot different. In the background here, I have the Social Security and dividend income already added into this graph. So this graph just looks at the tax on IRA withdrawals. Again, the income goal is highlighted in orange. The reason this tax graph looks so different is that Social Security and dividend taxability is on a sliding scale. It doesn't generate a tax liability until you start taking those IRA withdrawals. So as you start taking dollars from your IRA, you see higher marginal tax rates because you not only owe tax on the IRA withdrawals, but it triggers tax in those other areas, those other sliding scales. Again, going back to the retirement contribution cheat sheet, we care about the taxes we pay or avoid on contribution, and we want to compare those to the taxes we pay or avoid on withdrawal. Now, thus far, I've just been showing things in binary terms. For instance, since all of the tax is being generated by IRA income, I just looked at all of the tax as a percentage of the IRA withdrawal. The thing is, we don't have to be binary with our withdrawals, or really with our contributions. We don't have to decide to contribute all to Roth or all to pre-tax, and we don't need to decide to withdraw in that way either. We can do portions of both. Let's remember that we are comparing to a 22% tax rate on contributions. So anything that we can withdraw at a rate below this, we want to go pre-tax. Anything above, we want to go Roth. So zooming in on this graph, we can see that the first $10,000 that we would take in IRA withdrawals, we would pay no tax on a portion and 18.5% on another portion for a total tax rate in this zone of 12.3%. After this, we see a lot higher marginal rates due to those tax hurdles we discussed. If we took Roth withdrawals here, we avoid taxes of 26.9%. It would make sense to contribute to Roth to be able to do this. What we are doing here is looking at a tax rate over a range to make better decisions. Some advisors call this effective marginal tax rate. This term to me is just adding a little bit to confusion because really this is just a definition of a marginal rate. Marginal rate is just the tax rate you pay on a step of income, whether that's a $1 step or a $20,000 step of income. Now, I want to be very clear here with this example. I don't expect someone to perfectly map out their working income and then forecast all of their retirement income and future tax rates and do this exact comparison so they can say, Okay, based on this, I should have 24.5% of my contributions to traditional IRA and 75.5% should be Roth. It's unrealistic to think that we can have that level of specificity, but having a deeper understanding of what your retirement tax brackets will generally look like can help you make far better decisions. With this example, the main takeaway here is that it makes sense for this worker to diversify, contribute some to both Roth and traditional IRA. If we believe the common adage that taxes will be lower in retirement, and we just compare something like effective tax rates, it's easy for one to assume that they should defer, and contribute all to those pre-tax accounts. If we were binary, we'd actually see that we are better off contributing all to that Roth. But we don't need to be binary. Some combination of both will leave this retiree with a lot more options in actual retirement. Now, every situation is different. There are times when someone will want to do all Roth or all pre-tax. Do not use the example in this video to project out your exact situation. Some personal projection is still needed. We don't want to hold on too tightly to the exact numbers. Just don't fully believe the idea that taxes will be lower in retirement, because it's only partially true. Effective tax rates will be lower, but that's largely meaningless. It's the marginal rates that we care about. Thanks for watching this video. If you want to learn more about how to make the best contribution decisions, how to make the best withdrawal decisions, really how to make the best tax decisions, period, in retirement, there is a tool that is an absolute must for retirees. It's a tool that we use to create the tax charts that you see in this video. Click here to learn more, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.